activity of both companies. Alliance Bank background. Alliance Bank and its subsidiary Alliance Islamic Bank Berhad, a dynamic, integrated financial services group offering banking and financial solutions through its consumer banking, SME banking, corporate and commercial banking, and Islamic banking business. Wholly owned subsidiary of Alliance Bank Malaysia Berhad, ABMB, was established in June 2007. AIS provides end-to-end Islamic banking solution across segments. It's a wide range of Sharia-compliant financing, deposits and transaction services to individuals as well as business owner and corporate customer. AIS offers takeover and wealth management products for a complete financial management solutions offer. Its offering include retail banking service like savings account, loans and credit cards, SME and corporate financing solution, investment banking service such as advisory, capital market activities and equity underwriting, and Sharia-compliant Islamic banking through Alliance Islamic Bank. The bank is recognized for its strong focus on small and medium-sized enterprise SME, wealth management services, and its commitment to digital innovation, providing advanced online and mobile banking platform for efficient financial management. Evergreen Fireboard Berhad background. Evergreen Fireboard Berhad is primarily involved in the manufacturing and distribution of engineered wood-based products. Main business activities include the production of medium-density fireboard (MDF), particle boards, and value-added wood products such as ready-to-assemble furniture, laminated boards, and wood-based panels. The company caters to various industries including furniture manufacturing, interior design and construction with operations spanning both local and international markets. EFB manufactures and distributes engineered wood products. The company designs and develops medium-density fireboard, MDF and particle boards (EFBs). Downstream products include paper, veneer, printed melamine board, laminations, saw rubber wood timber, biomass wood pellets and other upstream products including resin and glue. First, furniture products such as workspace and storage system, kid study tables, living room furniture, hall dividers, bedroom furniture, cabinets, desks, kitchen furniture, shoe rack, wardrobes and bookcases. It operates manufacturing facilities in Malaysia, Thailand and Indonesia. The company has business presence across Europe, the Middle East, Asia Pacific and the US. EFB is headquartered in Parit Raja, Johor, Malaysia.
In part 2.0, that is ratio analysis, we will compare the liquidity ratio, the activity ratio, the profitability ratio, and the leverage ratio of Alliance Bank and Evergreen Fireboard for the year 2023. In part 2.1, I will discuss about the liquidity ratio, focusing on current ratio and quick ratio. Firstly, the current ratio. The current ratio is used to measure the ability to pay short-term liabilities with current asset. The formula is current asset divided by current liability. In the year 2023, Alliance Bank had a ratio of 1.09 to 1, while Evergreen Fireboard had a stronger ratio of 1.58 to 1. This means that Evergreen Fireboard has 1 ringgit 50 cent in asset for every 1 ringgit liability. This showing a better liquidity compared to Alliance Bank. Secondly is the quick ratio. The quick ratio excludes inventory and measure liquidity with the most liquid asset. The formula is quick asset divided by current liability. Alliance Bank quick ratio is 1.09 to 1, slightly better than Evergreen Fireboard that is 1.02 to 1, indicating Alliance Bank have a more stronger immediate liquidity compared to Evergreen Fireboard. To sum up, Evergreen Fireboard has a higher current ratio, whereas Alliance Bank has a better quick ratio. Both ratios offer important insights into their financial condition.
Hi, my name is Sanjara. So today we're going to present about 2.0, the radio analysis, and my part is 2.2, activity radio. So what is activity radio? Activity radio are financial metrics used to measure how efficiently a company operates. So they compares various radio that assess how well a company uses its capital or asset. So these radio are available for tracking a company's performance over time in horizontal statement analysis or for comparing its performance with peers in similar company analysis. So we're going to do a research about total asset turnover. So what is total asset turnover? total asset turnover ratio measures the value of company sales or revenue relative to the value of its asset. So the asset turnover ratio indicates essentially how a company is, and if a company has a low asset turnover ratio, it means it is not essentially using its asset to create a revenue. The formula of asset turnover is the net sales of the company and divided the average total asset of a company. So from the research, we know that Allianz Bank have a 0.03 of total asset turnover, and Evergreen Fireboard company have a 0.09 total asset turnover. This means that we're going to choose Evergreen Fireboard compared to Allianz Bank for the year of 2023 because Evergreen Fireboard are more able to use its asset efficiently and turn over its asset at a faster rate than Allianz Bank. So now we're going to introduce another ratios. It is account receivable turnover. So what is account receivable turnover? It means it measures the number of times a company collects its average account receivable balance. So we're gonna know that an efficient company have a higher account receivable ratio, and conversely, an inefficient company have a lower ratios. So we know that the formula of current ratio is net sales of a company and to divide the average trade receivable of a company. So from the research, we know that Allianz Bank have a 0.54 of account receivable turnover, and Evergreen Fireboard have a 0.37 of account receivable turnover. So from the research, we're gonna choose an Allianz Bank compared to Evergreen Board because Allianz Bank collection of account receivable is efficient, and there is a high proportion of quality customer who pay their debt quickly that Evergreen Fireboard.
Hi, I'm Alia, and I want to talk about profitability ratio of the Allianz Bank and Evergreen Fireboard. Firstly, what's a profitability ratio? Meaning of profitability is the ability of company to make a profit in one time period in sale level of company within a form asset or share capital. Because of that, profitability ratio is mean of user evaluate a company's ability to earning profit relative to its revenue, asset, or net equity or other financial element. The ratio is used by creditor, investor, and management of company to know how competitive and efficient company can generate income. In this profitability ratio, and I want to discuss about profit margin on sale and ratio of on common shareholder equity. Now, what is profit margin on sale? This margin meaning of a profitability ratio that measure amount of net income and earning of sale will be generated by comparing the net income and net sale of a company. However, this profit will show the percentage of sale are left over after paid all expense in business. External user, which is creditor and investor, usually use the measure to see how effective and efficient a company to convert sale into net income. Internal management of company use the ratio to perform goal in future. The formula margin on sale is net income divided to income sale. If you can see this table, Allianz Bank get 35% and Evergreen Fireboard get 38%. This meaning we need to choose Allianz Bank based on profit margin on sale compared to Evergreen Fireboard for the years 2023. The reason is because Allianz Bank can earning 35 net income over than Evergreen Fireboard, which is only can earn 38 net income. The results show that for every RM1 of net sale, Allianz Bank can afford RM0.35 net income, but for Evergreen Fireboard can afford for every one of net sale only can add RM38 net income. It represents that Allianz Bank are more able to give more amount of net income from net sale. However, return on common shareholder equity is measure of company financial performance. The ratio is a way of showing a company return on net asset. Return on common shareholder equity is considered of corporation profitability and how efficient it generates profit. The higher the return will be more efficient. A company's management is generating income and growth for its equity financial. The formula is net income the formula for return on common shareholder equity is Net income minus preferred dividend divided to average common shareholder equity. You can see this table that Alliance Bank got 6%, Memorial Evergreen Firewood get 3% of return common shareholder equity. This means we have to choose Alliance Bank based on return on common shareholder equity compared to Evergreen for the year 2023. The reason is because Alliance Bank can exceed % net income over the Evergreen Fireboard, which is only can earn 3% net income. The results show that for every RM1 of common shareholder equity, Alliance Bank can afford RM0.06 net income, but for Evergreen Fireboard can afford for every RM1 of common shareholder equity only can earn RM0.03 net income. This represents that Alliance Bank are more able to give amount of net income when divided with average common shareholder equity.
Hello everyone, my name is Muhammad Amsyar Sahmi bin Ahmad and my metric number 307578. Today, I will walk you through a little bit about leverage ratio and describe the ratios of both companies. Leverage ratio are financial ratios that describe the way a company uses debt as compared to its equity, assets or income to understand the company's financial structure with regard to risk involved. They clarify how much a company relies on borrowed funds to conduct its operation and its ability to meet that obligation. Leverage ratio divided by two categories, which is debt to asset ratio and debt to equity ratio. What is debt to asset ratio? It is indicative of how much of a company's total assets are funded by debt. The debt to asset ratio measures the extent of its financial leverage. The total asset associated with an entity can be calculated by practically deducting the value of assets from total debt. And what about debt to equity ratio? The debt equity ratio is a financial tool that shows the company aggregate debt to debt of the owners. Most debt is generally used to the amount contributed by shareholders, and the debt equity ratio thus informs about the debt used to finance operation of company. Hello, welcome back with me. For now, we will discuss about comparison of each ratio between Evergreen Fiberboard Berhad and Alliance Bank. We have 8 ratios to compare. So, the first one is current ratio. Evergreen Fiberboard Berhad has the highest current ratio, which is 1.58. Then, Alliance Bank, which is the current ratio is 1.09. We need to choose Evergreen Fiberboard Berhad, who has the highest liquidity in asset. The second one is quick ratio. Alliance Bank has the highest quick ratio, which is 1.09. Then Evergreen Fiberboard Berhad, the only ratio is 1.02. We need to choose Alliance Bank, who has stronger liquidity in asset. The third one is total asset turnover. Evergreen Fiberboard Berhad total asset turnover is higher than Alliance Bank, which is 0.5 times, and Alliance Bank is 0.34 times. We need to choose Alliance Bank because they are using assets more efficiently compared to Evergreen Fiberboard Berhad. The fourth one is account receivable turnover. Alliance Bank account receivable turnover is higher than Evergreen Fiberboard Berhad, which is 0.45 times, and Evergreen Fiberboard Berhad is 0.37 times. We need to choose Alliance Bank because this group convert account receivable into cash faster compared to Evergreen Fiberboard Berhad. Next, profit margin on sale. Alliance Bank has the highest profit margin on sale, which is 35%. Then Evergreen Fiberboard Berhad, that only percentage is 28%. We need to choose Alliance Bank because it indicates better cost control and profitability compared to Evergreen Fiberboard Berhad. And other than that, return on common shareholders equity. Alliance Bank has higher percentage, which is 6% than Evergreen Fiberboard Berhad. That percentage only 3%. We need to choose Alliance Bank because it has better management of shareholder investment compared to Evergreen Fiberboard Berhad. The seventh one is debt to asset ratio. Evergreen Fiberboard Berhad has a lower debt to asset ratio percentage, which is 32%. Then Alliance Bank percentage is 90%. This means Evergreen Fiberboard Berhad has more asset than liabilities compared to Alliance Bank. And the last one is debt to equity ratio. Evergreen Fiberboard Berhad has lower debt to equity ratio percentage, which is 0.56 then Lion Bank percentage is 86%. It means Lion Bank has more liabilities than shareholders' equity in 2023.
Suggestions on how both our companies can improve their current performance. First, utilizing assets efficiently. By utilizing assets, Evergreen Fiber Berhad and Alliance Bank can improve profit margins. When assets used effectively, production costs per unit decrease, allowing for higher profit margins. First of all, both of the companies should plan for a strategic partnership, collaborate with other business to co-utilize assets like shared manufacturing lines or co-branded financial service. Secondly, both of the companies should manage data-driven assets. They could use advanced analytics to monitor asset performance and identify underutilized areas. Second, leverage technology. Both companies should use AI and data analytics for operational optimization. Both companies should utilize data analytics for strategic decision making. Alliance Bank can analyze customer behavior to tailor financial products and predict loan defaults, while Evergreen Fiber can use predictive analytics, forecast demand, optimize inventory and anticipate market trends. This will actually save you more costs. It's reduce labor and operational inefficiencies and improve decision making too. Data-driven insight lead to informed strategies. Third, optimize debt usage. Both our companies can optimize their debt usage by adopting a strategic approach that aligns with their business goals and financial structures. Alliance Bank should focus on managing financial product and balancing deposit with loans, while Evergreen Fiber should emphasize cost control, capital investment, and efficiency in debt management. As a financial institution, Alliance Bank could maintain a balanced loan-to-deposit ratio (LDR) to ensure that the LDR stays within optimal range to prevent liquidity constraint and unnecessary debt exposure. For manufacturing company like Evergreen Fiber Berhad, they can focus on optimized debt-to-asset ratio, which is aim for a balanced ratio by increasing operational efficiency and asset utilization, which can reduce the reliance on debt.